Hello, and welcome back to another episode of the Fintech Takes podcast. In this episode, we have a special guest come on, first-time guest, David Roos, who is a partner at Core Innovation Capital and someone I've known in the space for a while. Unlike a lot of other investors, VC investors who jump around a lot of different industries or kind of follow what's hot, David and Core Innovation Capital are very focused on fintech. And I wanted to have him come on to talk a little bit about changes in the venture landscape, how to balance financial returns for a VC firm against the impact that your funds are having on the end lives of consumers and small business owners. Obviously, we talk about a lot of the hot topics in fintech these days, including open banking and AI. But I also asked David to go a little deeper into some of the trends and theses that he's interested in that might not be quite as high on folks' radar. It was a great conversation, and I really appreciated having the opportunity to catch up with someone who's on the ground on the VC side, because as we've seen, what happens there shapes the incentives for the entire market. So it was great to talk to David, and I can't wait for you to listen to this episode. So without further ado, here is David Roos. David, thank you so much for coming on the podcast.
Absolutely. Thanks for having me, Alex. Long-time listener.
First-time caller, although not the first time that you and I have chatted, not even the first time that we've gotten to see each other. In fact, I think one of the last times we spoke, it was at one of the many industry conferences that I know you and I cross over at, but I'm glad to get reconnected with you. I feel like the ecosystem has changed a bit since the last time we talked about it, and I'm always kind of interested in hearing about the venture side of the fintech ecosystem, because I feel like it's one of those areas where I pay attention to it. It's a little like sports for me, where it's like I watch the box scores, but I don't play. And so it's a little, sometimes you lose track a little bit of what's happening on the ground. So my thought for this episode is we can start by talking about kind of the investing side, and then would love to get your take on some of the latest stuff that's been happening in the fintech space, a lot of which I've talked about on the podcast, but it'd be great to hash out with you. Does that sound like a plan?
Yeah, that sounds like a plan.
Okay, well, let's start here. So I'd love if you could give a little bit of background beyond kind of my quick intro that I did for you in the introduction for this episode on Core Innovation Capital, what you guys do, and sort of what your focus is.
Yeah, absolutely. So we are an early stage investment fund, largely focused around the seed and early A. And, we started off back in 2010 and really focused on financial inclusion, financial wellness for the unbanked, largely low middle income. Really with this idea that the most scalable businesses will have the largest impact on consumers, and tech can do so much for the bottom of the pyramid. Now, what we realize is over time is that it's not just the low to moderate income folks that are financially insecure, but it's actually the 90% of America has some financial insecurity in some fashion. And when you're looking at financial wellness, it's not just financial services, but it's actually everything that makes up household GDP. So it's financial services, housing, healthcare, small business enablement, these big ticket items that really affect everyday life and represent $1 trillion markets. And so, at the core of what we do is how we phrase it as unlocking wealth and health for the mass market. So really focused on being a top decile fund from a financial perspective, and we've proven that out. Top 5% funds in the past. But we also have this mission of how do you unlock wealth and health by really helping people make more money or spend less money, and focus on that bottom line for the household.
Got it. That makes a lot of sense. So I wanted to ask you about that actually, because I find in general that there is a bit of a tension, at least the way that other firms, I think, sometimes look at those things, right? I mean, we all want to, I think, connect the work we do every day to impact on consumers, on small businesses. I mean, you hear everyone in the ecosystem talk that way. I talk about writing the newsletter that way, to be honest with you. But at the same time, obviously, we all have fiduciary responsibility to someone. And you guys obviously need to sort of run a great fund monetarily and return funds to your investors. So how do you guys think about navigating the balance between sort of maximizing for returns versus maximizing for the positive impact on that mass market? Like, how do you approach doing that? Do you try to measure the results you have on both sides of the fence? Like, how do you think about that?
Yeah, so I'd say, first and foremost, we are a venture fund that's aims to be a top decile fund, and so every single investment we underwrite the same as every other venture fund in terms of financial success. But we see the impact side as a competitive advantage, and so when I look at businesses that are the most successful and entrepreneurs that are the most successful, they're the ones that really put the customer first. So the ones that find alignment with the customer and making money, those are ultimately the businesses that really succeed. I always like to point out here that, and it's become a little bit more controversial recently, but I equate it to kind of how Elon picks, best entrepreneur of our lifetime. I think most people wouldn't argue with that. He focused on a few big issues, climate change, disrupting banks, and getting to the moon. And so that dictated where he spent his time. And he went out extremely mission driven and built a business that just built three businesses that absolutely revolutionized those industries. So I think there is this world where you have when you are extremely mission and customer oriented, you end up creating a much more profitable business. Amazon, Apple, OpenAI, these are the largest businesses in the world. They've created unbelievable value for their customers. And it's not just on the consumer side too, it's also on the infrastructure side. We spend probably 75% of our time on the infrastructure side with this belief that you have to modernize the back end in ways that increase access and affordability on the front end. I mean, you look at, Stripe, biggest fintech in our field, still private. Think of all of the good that they've done for society, and all of the businesses they've been able to create. So that's kind of how we think about it. These aren't two worlds that are, butting up against each other. They actually work out really well together.
That makes sense. And I guess just to double click into that for a second, and I'll use Elon as the example here. I think the other component to that that's interesting, right, is, and I'd love to get a sense of how you guys think about this, particularly in terms of finding the right founders or the right teams, since you guys invest in the earlier stages. One of the things that Elon is really good at is sort of pressing the limits of what's actually like physical reality, right? And so he's fairly well known for I think he calls it the algorithm, but it's basically like this process that he goes through where there are no assumptions in his world, right? Like if we're trying to get into space and create a multi-planetary species, as he likes to talk about it, we need to lower the amount of money it costs to send a pound of something into orbit. Okay, well, what are all of the components that go into sending something into orbit, down to like the screws that are used to fasten plates to the space shuttle? Well, who makes those screws? Why do they make them that way? Why do they cost that amount of money? And so there's sort of this obsessive attention to details. And I know everyone talks about thinking from first principles. He actually does think from first principles. Totally. He gets all the way down to the base reality. And I think that's important in the context that we're talking about it, right? Because again, like it's not a novel idea or an inobvious idea to say, well, we're going to make money by serving the most customers. Like the mass market should be appealing to everyone, right?
Yeah.
Like we should be able to make a lot of money in financial services, serving a bigger customer base. There are very good reasons why we don't, whether it's consumers who are lower income or unbanked or credit invisible, or we're talking small businesses that don't have credit files at Dun and Bradstreet. Like there's a reason why those markets are underserved, despite the fact that they are fairly obvious commercial opportunities that thousands and hundreds of thousands, maybe millions of people have spent many, many hours thinking about how to serve them better. So when you guys are evaluating either on an infrastructure level or on a direct to either business or consumer level, when you guys are evaluating founders and companies, what attributes do you look for to help you figure out, like, are they doing something different here? Because again, like many people have crashed up against these rocks before without necessarily making any progress. What tends to differentiate the founders who actually can break past some of those structural barriers?
Yeah, you're totally right. The areas we're playing in are the most operationally and regulatory complex environments that you can possibly draw up. So you definitely need the right founder mentality. I also think that it's a very interesting time because, we have so much pain in society across the board. You're seeing it in just in terms of housing unaffordability, and in terms of healthcare costs. The murdering of CEOs, the increasingly nationalist rhetoric. You have New York that has a self-proclaimed socialist that now is the front runner for mayor. So these are all things that are no longer just the underserved market. This is clearly the mass market. So we think this is a very interesting time to be serving this market as well. But when it comes to what we look for in the founders, and equating it to Elon too, there's this intensity that they must have. They have to be incredibly driven, incredibly obsessed with this problem, and super visionary too. Because you're right, if you just look at it from the outside, like there are so many walls that you're going to have to run through, so many barriers that no rational founder would want to attack. And so we look for this, we call them misfits, just like incredibly mercenary and incredibly missionary founder that's just like obsessed with the problem. And there are some signals you can find, like hyper responsiveness I found is like very correlated to a founder that is just like always obsessed with this problem. Compelling content in the area is another one. And then just like a track record of going deep in that field. So that's number one. Number two, obviously, is accomplishments. Elon has that too. Are there any past achievements? It doesn't have to be in this field specifically, but like areas where they've just shown that they can get to the top of their whatever they're trying to accomplish. Three is just being a magnet for capital and a magnet for talent. That's something that, particularly in these like operationally and regulatory complex fields, you need to be able to convince people to work with you and really buy into that. And you need to be able to convince people to invest in you. And it's not the sexiest spaces. There's time, 2021, everything in fintech was sexy, but it's not always the sexiest spaces. And the best businesses often have at least a few funding rounds that are just very challenging to get through. So you need to have this founder that just has a knack for attracting capital. And then, finally, like, and maybe most relevant here is some sort of self-awareness. I think the founders have to be the ultimate optimists when it comes to their business. But we found that the best founders also have a level of hubris around what they can and can't do and where they'll build around themselves. And so, we're always looking for some level of self-reflection in those initial conversations where, they're not going to try to go about doing this all by themselves, because it's going to be really, really hard to do so, even with AI.
Yeah, well, and we'll get to AI, but no, that's interesting. I mean, I think it is hard, right? Because the balance between sort of self-awareness and hubris, especially when you're founding a company, there's a thin line there. So I think evaluating that is definitely, I'm sure it's probably an art. You mentioned kind of 2021, just building on that. I mean, obviously you've been investing in the space for a while. I feel like I'm going to be, bouncing my grandkids on my knee decades from now, telling them about 2021. Like, it was a pretty crazy time. Although in some ways I feel like, we are kind of seemingly headed back into a somewhat sort of manic period in the market, at least in certain areas. So be curious to get your take on how the dynamics in venture investing have changed over the last 5 years or so. Just because we did kind of go from like very strange COVID years to sort of like the boom times to end all boom times to obviously kind of a pullback in the space and broadly to now, I don't even know where we are now. And so, I mean, I'd just be curious from the venture perspective, kind of how things have changed.
Yeah, I'm sure you'll be have your grandkids on your lap talking about 2025 as well, with all the craziness that's going on in the market today too.
It does seem so, yeah.
Yeah. So, I mean, the venture market it feels wildly different than 2020. And, Core's been in business since 2010, and it's very different from those early days when we were kind of fintech OGs, and now there's a bunch of people interested in the area. It's interesting. There's quickly becoming this bifurcated market where you have these massive multi-billion-dollar funds that are sucking up a lot of the capital in the industry. And for better or worse. And then you have these small funds that are more, sector specific, really try to play at the earliest stages, and punch above their weight and really understanding specific domains. And that's where we play. I think you have this like messy middle where it's become tougher to play, because if you're a generalist playing against these massive funds that are offering a lot of dollars, it becomes just harder to kind of pitch your diversification. And I think it's just, this has become the norm much more now than it was in 2020. It's become a much more competitive market in that respect as well. It's not necessarily good for the market either. When you have these massive funds, the early seed and even Series A becomes more like option bets for them, where they'll put in a check, but $5 million check out of a $2 billion fund isn't going to move the dial for them. What they're really doing is saying, hey, if you work out, we'll put in a big check later on. The problem there is if you don't work out, it's going to be very challenging, number one. And two is it'll be a bad signal to the rest of the market, because then, if they're not backing you at that next round, it becomes more difficult. And then three is if they're doing too many of these checks, it's impossible to spend too much time with the founder. Whereas where we come to play, every check is meaningful to us at our fund size. And so that's where, every check I'm going to be, super responsive to founders, because, I have the same alignment around carry as they do around a great outcome, as opposed to making money on management fees. So that's a big difference in how it's playing out now versus 5 years ago.
That makes sense. I mean, it's interesting. I've definitely seen that dynamic, again, just sort of watching the scoreboard from a distance. But, it's been interesting watching founders, and I spend a lot of time talking to founders, try to navigate that dynamic because, as you're saying, I mean, it's really tempting, I think, to sort of play the game of fundraising without like kind of thinking about how it impacts the prospects for your business, right? Because everyone would prefer, I think, to raise a bigger round than a smaller round. People tend to prefer raising money from well-known VC firms that have a certain sort of shine to them that you can kind of transfer a bit to your business. But all of those things, particularly at the earliest stages, they come with risks later on, right, as you're talking about. And I think that was one of the things I noticed about the sort of 2021 mania that I'm kind of watching this time around as well is, as these funds try to sort of play that option game and get a seat at, potentially future interesting tables by dropping a little check-in that's not actually that little, it does sort of distort the ecosystem because I think founders, particularly ones who are less experienced, they might not understand what the sort of downsides are of taking that route. And, money is funny. It has a very distorting effect, I think, on the way that people build. I always think about, Klarna as one example, pretty old fintech company, actually, that had been kind of puttering around in Europe for a while before 2020, 2021, when BNPL became a really hot area all of a sudden. And, when you have SoftBank come and knock on your door and offer you billions of dollars, it doesn't really make sense to say no. But I also can really see a change in the way that Klarna, just as one example, kind of operated their business before and after receiving that money. And, hopefully they'll be able to kind of get back to a good water level and maybe have an IPO soon. But, it kind of put them in a weird place after they raised that huge amount of money because it was hard to live up to. It came with different expectations around growth. I mean, it can have a distorting effect, right?
Yeah, completely. And it's funny, we typically see a very different approach from the first-time founders versus multiple-time founders, whereas multiple-time founders normally won't try to raise as much money as possible as early on, versus first-time founders, it's super hard to turn down money, particularly from a brand name. So I don't fault them on that at all. But the second-time founders, like, all right, let's do this in a measured way and reach product market fit, and then and once we have an area to spend that money, then we'll go raise the money. And the other big difference, I think, is that the second-time founders actually are the ones that probably could raise more money and we'd be more comfortable with it because they're less likely to go out and just spend it right away, versus it's really hard to have dollars in your bank account and not want to go spend it. And you get into this world in which, when you run into walls, you're not going to your customer to see, what's wrong? Like, how do I, what do you love about us? What can I do better? And go deep into really understanding your customer. Instead, you try to solve problems with money. So that's a challenge.
Well, and it feels like there's always someone offering you a solution if you give them money, even at those early stages, right? And it could be, hey, I'm a great salesperson. You should hire me and I'll fix all of your problems. But I think you're right. I mean, it's one of those things where in the early stages, in a lot of ways, you're assembling a machine that when the machine's fully built, then it needs a large infusion of capital to scale up. But until you've built all the pieces of that machine, more money, I mean, it's trite to say, but like more money just comes with more problems. And it's really not the solution that you might think it is. But if you haven't been through that journey before, you might not know that. Plus, the other thing, and this kind of ties to the environment right now, and maybe we can talk a little bit about M&A and IPOs and that kind of stuff. But a lot of this is also so timing driven, right? I mean, like I'm struck by the number of founders I've spoken with over the years who just had bad timing as it relates to like when they went to raise their seed, when they went to raise their Series A, when they went to raise a Series B, who they raised the Series B from, what happened in the macro economy right after they raised their Series B. So, I mean, it's just, is so much of it, and it depends obviously on the business. Some are a little more sensitive to sort of larger economic trends than others, but in general, like, a lot of it has much more to do with timing and, is the IPO window open? Did, this fund just get a big return on a portfolio that had been in their company that had been in their portfolio for years? Like, a lot of it is just stuff that's outside your control. So I'm curious, where, from like a timing perspective, are we? I mean, obviously, we've seen a decent amount, I guess I would say, of M&A activity. We've seen a few sort of large scale, very sort of brand name IPOs. But it also doesn't feel like the spigot's fully turned on either. Where are we right now?
Yeah, it's interesting because, the venture world for fintech still has been very quiet when it comes to fintech specific. Obviously, there's a ton of excitement around AI, and a lot of companies that actually are fintech companies, I would call them fintech companies, are branding themselves as AI. So if you look at the stats, maybe the fintech market is more down than in actuality. But then the IPO and M&A market has largely been led by, Chime and Circle. You have Klarna and Figure announcing this week that they're readying for IPO. You have Privy and Bridge that are getting acquired by Stripe. So a lot of the activity in M&A and IPO market has been led by fintech, and so it's still an awesome place to be from that respect. A lot of the biggest exits in venture have and will still be fintech or related to fintech. Now that everyone has a fintech strategy, but in terms of where we are and what we're seeing is that a lot of pipeline for M&A has expanded over the last year. April through June, people were hesitant with quote unquote Liberation Day. And the tariff announcement, and so people had to put that on pause. Now they're back, and so I think we'll see more M&A coming up. IPO still feels like the bogey is so high. You still need to get to what seems like $1 billion in revenue to be able to be an IPO-able business, just to have the coverage necessary from the proper Wall Street analysts. And that's very different than it was 5 years ago, when you could have 250 million and IPO and have a solid exit, and you're not one of the like massively high flying ones, but it's a good outcome for 99% of American venture. And so I still think like we are at this kind of weird barrier where it's slightly open, but still mainly closed. And so, I don't know that it changes until there's no other option. And right now, because you have those big funds with billions of dollars and a lot of interest in private markets, you still will have a lot of businesses that are staying private for longer.
I will say, as a side note, we're going to stay private perpetually forever model. I have a really hard time wrapping my brain around it. I know it's how the markets work right now, but it is very strange because it does distort, I think, the way the public markets work and like investors' expectations. But B, you can also sort of rationally, it's like a game theory problem, right? Like you can understand why the founders and executives of those companies would prefer to do it, because being a public company is super annoying on like 9,000 different levels, and it's subject to a lot of things that suddenly are out of your control. Like it's not any fun, but the fact that it's less of a requirement to get to that point at a particular time in your company's trajectory is very strange. And I mean, who knows, when I'm bouncing my grandkids on my knee decades from now, I might be talking about, yeah, I'm still waiting for those Stripe shares to come through, but any day now, I'm
Yeah.
sure that they will. It's a very odd thing.
And it's
David,
another one where it's just tough to fault those businesses. Like,
it
of
is, yeah,
course, if you have loads of dollars coming your way at higher prices, why would
yeah.
you go through the effort of becoming a public company when being a private CEO is so much better than being a public CEO?
Totally. Yeah. No, I mean, it's as long as the money is there, why wouldn't you do anything other than that? And it's probably a larger comment on just the structure of the markets these days that this is feasible. But yeah, it's wild. And we're going to get to some of these areas as we talk about stablecoins and AI, because I want to talk a little bit about just fintech stuff, since
Mhm.
obviously like that's what you guys specialize in. That's where you spend all of your time. So let's hit some of the kind of buzzy news headlines. And then we'll wrap up by talking about some of the stuff that's maybe not as much in the news. So, first thing I want to ask you about is open banking. Obviously, we're in the midst of whatever it is that's happening right now. Obviously, the CFPB is revamping the open banking rule, which is still in effect. And we are still headed at the moment towards the first set of compliance deadlines hitting in April of next year, at least for the moment. But the CFPB is working on revisions to the rule. Obviously, their engagement on the issue was prompted pretty directly by Chase throwing its weight around in the market and proposing fees, which are also still theoretically something that are happening and moving forward, although I wouldn't be surprised if those get paused. David, what was your take on the JP Morgan Chase news and kind of everything that's followed that? Like, what do you see when you look at this area of infrastructure, which I know infrastructure is a big focus for you guys these days?
Yeah, well, first of all, I should probably check on when you're actually posting this podcast to see what the how things have changed and who's visited Mar-a-Lago this week to dictate.
I've decided I just can't like let when I record the podcast dictate what I talk about, because it changes like every day, every couple of days. It's wild.
Yeah, yeah. So obviously, we're big investors, big believers in this space. We backed
Mm-hmm.
Prism, Spinwheel,
Mm-hmm.
Atomic.
Mm-hmm.
A bunch of companies that are benefiting from open banking.
Yeah.
And yeah, how I see it, one is bullies are going to be bullies.
Mm.
JP Morgan has tremendous brand recognition, has
Mm-hmm.
tremendous control. They've just gotten stronger. And talk about things that have changed in the last 5 years. They were a strong brand. They've gotten so much stronger post
They're bigger
SVB.
and stronger. Yeah.
Yeah,
Yeah.
they are bigger and stronger and have more control.
Mm-hmm.
Jamie Dimon is bigger than ever. And so, they saw their opportunity to be bullies in this market and take advantage of it. Um, it makes sense too. Another place where you probably can't blame them that much. And they're going after, an area that's a threat to them, and largely focusing on payments use cases, where they make a lot of dollars in interchange. And so as you make it easier to move money around and get around their interchange business, then they're obviously going to have some response. I don't think they were counting on crypto coming to the rescue, but
Yeah, I don't
uh,
think so.
yeah. But how I see it is, and this will take time to play out. And I've talked to all of our portfolio founders, and
Mm-hmm.
largely there's been limited. It's just way too early for this to have any effect on the fintech market. So from a day-to-day business perspective, there hasn't been much change. I think the cat's out of the bag on open banking. Even before 1033, we were moving from a world of closed data to open data. Around the world, we've been moving from closed data to open data. I don't know. Obviously, it would help to put pen to paper on this ruling, and it's just a frustration if it does. If it does go down, because this was a bipartisan movement that I think everyone could agree on. This isn't a Democrat versus Republican thing, but but I think over the next decade, if you ask me, in 2035, are we in a world of open transferable data? then I would say absolutely. Like we are moving down that path, no matter how many ups and downs we have in this time period.
Yeah, it's interesting. I mean, I agree with you. It just seems like, at the end of the day, I think the challenge for banks in this space is, you just can't really argue that it's not the customer's data, right?
Mm-hmm.
And it's so funny when you talk to bankers about this, they're very different from each other, right? Like JP Morgan Chase does not represent all banks in the ecosystem, obviously. And some bankers you talk to are like, oh yeah, no, of course, like we want to move to this open world. We think we'll thrive in it because we're kind of building for it. And this is how we think about our relationship with our customers. But there are other bankers you talk to who they won't quite come out and say it's not the customer's data, it's our data, but you can kind of tell that's how they feel. And it does, I think, tie back to this kind of point you were making about the cat's out of the bag. It's hard when the world changes and you have to sort of adjust the way you think about strategy and the way you think about these things. And, it's funny because I think that right around the same time, it's kind of unfortunate for banks, really, but it's like, right around the same time that I think banks really started to get a handle on the idea that data itself is an asset and that they have a lot of it and that asset is very valuable and you can do lots of things with it. Right around the same time that started happening, this movement towards open data and consumer ownership and control of data really started to take hold. And it's like, it's funny when I listen to Chase or others complain about, like giving this data away for free and all the costs associated with it. Like, you furnish data to the credit bureaus.
Mm-hmm.
That comes with a cost. You're not required to do that. There's no law that says you have to do it. Unlike in open banking, where there is actually arguably a law and a regulation that requires you to do it. Like you don't have to do that in the credit space. The difference is that in the late 70s and early 80s, banks weren't thinking about data as an asset.
Mm-hmm.
Buy now, pay later companies like Klarna weren't thinking of data as an asset. Today, no large company that has a lot of data wants to give it away for free. No one wants to do that. And so it does sort of become more of in some ways, a policy question, I think, and less of a market question. And that's what I see with the CFPB, which again, not the most active or proactive agency at the moment. When they dove back into this rule, that's kind of what I saw them basically saying is like, we clearly can't leave this just to the public markets because, to your point, Chase is really big and they'll make their preferences felt in a very real way, absent any rules.
Mm-hmm. Yeah. And, we see this all the time too. Even when there's open data, there are mm-hmm. ways to make it challenging in other respects. And so, they're going to make you go through hoops, and it might be a good analogy to look at, closed versus open systems in other technology platforms. Like open source software, and even in AI, open source software competes with closed software in many mm-hmm. respects. And I think mm-hmm. that'll be the same thing here, where if JP Morgan wants to have a closed ecosystem, you're going to have mm-hmm. other banks see that as a competitive advantage. Just as Facebook tried to open source Llama after OpenAI became closed, you're going to have banks start to open up their data. And as a consumer, if I can have my money at BAML and have that move more freely and be in control of my data, then I'm definitely going to do that versus leaving it at Chase.
Yeah, no, I mean, a lot of this ends up being a competitive question as well. And I'll be very curious to see how that works. I mean, there's a lot of fintech companies too that have, from a product mindset, more of a closed approach, right? I mean, like mm-hmm. this was always the Steve Jobs Apple thing. Like closed gives you more control, which you can exercise that control in a lot of ways, including trying to create really tightly integrated experiences for your customers. And so in some senses, not in all, but in some senses, I can understand the desire for closed. It can even be sort of customer centric in a limited way, but I just think the competitive dynamics, to your point, are such where, it's just trending towards open, and I don't really see that changing. Mm-hmm. Let's pivot to a topic we've already mentioned a few times, but that I want to ask you about directly about, which is AI. I mean,
what's that?
You could say, what's that?
What does AI stand for again?
Yeah, it's a great point because, I mean, I don't even know what AI is anymore, to be totally honest with you. I used to know what it is, and now we use it as a phrase to describe everything. And as with anything that's sufficiently hot from an investment perspective, I'm kind of like not even able to distinguish between truth and reality anymore. The nice thing about that from my perspective is I don't necessarily have to, because I just write about this stuff. I'm not writing checks into these companies. So explain to me, David, what it's been like being an investor in fintech companies where AI clearly has like lots of utility, but in this age where founders know if I just say AI or rebrand everything I'm doing to AI, my odds of success fundraising go up tremendously. Like, how do you separate hype from reality?
Yeah, that's very hard in this market. I will say, just to start off, like, first of all, you need, and it becomes very clear when you talk to hundreds of businesses, you need some sort of AI strategy. And it's not just AI on the front end. Most businesses are not AI native businesses, quote unquote. But on the back end, what we're seeing is founders are using AI to go so much further. So it is funny. We talked about earlier how there are these rounds that have blown up in size because of just how much money is in the ecosystem. Yet we're in a time when your dollar can go so much further. And so we are really encouraging founders to lean in on AI on the back end, and you're seeing this like 10x founder that can do so much more by relying on AI tooling on the back end. So that's number one, is like seeing who's got an AI strategy when it comes to their business, not just on the front end.
And do you see, by the way, on that front, do you see like smaller teams or like teams with fewer people like being at a larger size or doing more than you used to? Is that like showing up in the actual like on the ground operations?
Yeah, totally. And I would say the bogey for Series A's, in 2021 was 1 million. Now I think it's closer to 3 million because people are just expecting you to get farther with those dollars. And we invested in a business last year that had burned 1 million to get to a 4 million run rate revenue with a team, of less than 10. And that's still it's an exceptional business, but it's becoming more of like what we're looking for in these businesses, is the ability to spend your dollars wisely. So that's been super fun, just incredibly fun to see like how company building has changed in the last 5 years. But yeah, then in terms of how we weed through the hype of AI, one is I do think you need something more than just the technology tailwind of why now. And because if it's just like, oh, AI makes sense in this area, then there's going to be 50 other businesses in that space that are also building there. You need to really have this unique insight into, okay, why is the pain point in this demographic so large that it'll force them to use technology, and it'll force them to use our technology. And we have some insight into how to build this product differently than others. So that's one. Two is, we really believe context wins here. And that could give the incumbent the advantage in a lot of different areas. And so still grappling with like, where are the areas in which startups win versus incumbents? And I think in a lot of these areas, you need to embed yourself in critical workflows in order to get the proper context to build an AI native businesses. Like in this world of infinite data, it really is context that is key. And so what that means is you need the distribution edge relative to the rest of the market. Coordination here is also super key. And this is where, I think it comes down to, in our view, AI is augmenting as opposed to replacing for the foreseeable future in these highly regulated, highly operationally complex industries that we play in: financial services, healthcare, insurance. And so you need to have the right coordination between your human that's going to be in the loop, the guardrails around this, and so that's going to be as key as context. And then the last one, last vector in which we're analyzing this, is really trust. Trust is key. We've been saying this for a decade at Core. Within financial services, trust is how you win. But there's a lot of infrastructure that needs to be built in order to build out these trust layers within AI. And so if there's not, if we don't hear like what needs to be done in your pitch on how you're building trust within this community, usually it's having some sort of human element and human engagement, then it's going to be really tough to believe this can take off in these. These are just high stakes environments.
They really are. Yeah. I mean, I keep coming back to when Sam Altman launched whatever OpenAI's new agentic tool is that can kind of do stuff for you. His tweet sort of announcing it was like, yeah, we're not exactly sure how people are going to hurt themselves with this, but we're pretty sure they are, but we kind of need them to show us how they are. And so we're going to release it. You guys should be careful with it. And it's like, oh my God, like this is so counter to how we think about launching anything in financial services. And I think it's important to point this out, like not just because regulators force us to, right? But because like, it's people's money, man. Like this, like it actually matters. Like this stuff can't break. And I think that, there is a bit of there are some of those trust layers and those translation layers that need to be built between what's being built on the cutting edge, which is really cool and very capable in a lot of ways. But like filtering that down to things that touch people's bank accounts in different ways is a totally different challenge. David, let's wrap up by not talking about the sort of hottest areas in fintech. We didn't even get to stablecoins, so we're not even gonna go there. And instead, would love to get your sense again, as people who've been in fintech for a long time and who have that sort of dual sort of mercenary missionary sort of outlook on the market. What are some kind of under the radar themes or areas that you guys are interested in, or that you're just kind of noodling on personally? That folks in the fintech ecosystem maybe should be thinking about more, or maybe considering building in a little bit more?
Yeah. So it's an interesting question. So taking my head out of AI, one of the areas I've been spending a lot of time in is within this intersection of healthcare and finance. And there is a lot of talk here. But one thing that hasn't gotten as much recently, because people kind of viewed it as a lost cause, is this shift from fee for service to value-based care and this outcome-based care. And I think it's really interesting from a fintech perspective, because there's this complexity on the payment side and the contracting side with payers, shared savings, performance-based incentives, stop loss insurance, all that need to be integrated into this operating system for value-based care. And so with a fintech mindset going into that world, I'm super intrigued. I've said it was away from AI at the start. There's definitely an AI tailwind to this business that's creating the ability to get all of this data and create this outcomes-based care. But there's much more than AI here, and that's one area that I'm super interested in. Another one is a lot of people talk about the transfer of wealth, and what I'm really interested about here is on the SMB side. So there's this demographic of an aging population that we're running these small businesses. that typically would pass it on to a family member. They no longer have a clear family heir. How are you going to pass this along? And I think one of the, a couple areas. One is again, like AI equalizes the services that are possible for these businesses. So, in terms of what the larger businesses would get from an investment bank, now you can have services that help an SMB, prepare for an exit without spending loads of dollars, and so that's a really interesting area. And then employee ownership, I think, is another interesting exit opportunity. You're seeing private equity tap into this more and more with their businesses, because it gets back to, when you align incentives, businesses outperform. And so, I think there's this kind of operating system that could be built for helping SMBs transition to employee ownership. That's a win-win-win, because when employees own more of the business, this is how Silicon Valley got built. When employees own more of the business, you're more likely to have larger outcomes. So that's I've looked a lot in that space. It's been very hard to invest in historically, because it's so services driven. But again, like, we're reaching the point where services is no longer as scary as what it was.
Right. No, that makes sense. And businesses outperform when there's more alignment, I think, is a good through line for the whole episode in a lot of ways, because whether we're talking about alignment in AI, or we're talking about alignment between VC investors and founders, or obviously we're talking about these small businesses performing well, like, that seems to be kind of what we're struggling for and aiming at across really the whole ecosystem right now. So that, David, is a great place to leave it. I'm glad we got to catch up on a podcast. We haven't talked for a little while, so why not record that catch-up conversation? Really appreciate you hopping on, and I'm sure I will see you out there on the FinTech trail as fall trade show season begins.
Absolutely. Thanks for having me, Alex.
Thank you.